Tom Burton and I'm the publisher for the Mandarin, and today we're speaking with Michael Blythe, who's the Chief Economist for the Commonwealth Bank. Michael and his team recently released forecasts for 2016. We want to explore those forecasts and understand their consequences for government and implications for the Australian economy. Welcome, Michael.
Thank you.
Michael, you came out with a pretty strong forecast for growth, 2.75% for the year, and we've had a lot of market volatility in the early part of the year. Are you still feeling confident on that number?
Well, certainly that volatility increases the general uncertainty in the outlook. But the issue there really is, I think, economists struggle to explain what is happening in markets because there's no one sort of economic fundamental that you can point to. So a lot of it does just look like market-driven volatility. If that recedes soon, then I think we'll see the growth outlook is probably left undamaged. The longer it goes on, of course, the bigger the risk that we see a negative impact on business and consumer confidence, and that could certainly flow back into the economic story this year. So risks have gone up, but I think the central forecast still looks good at this point.
Right. And you're slightly above consensus in your forecast. What underpinned that confidence you had in the Australian market?
Well, the difference in our forecasts from the consensus is that we can actually see a little bit more consumer spending coming through than is built into most people's forecasts. And we think that the non-resource export part of the story is actually in better shape as well.
Right. And let's talk about this, the non-export side. I certainly saw in your predictions there some numbers predicting some stronger uptake in sectors such as tourism, education, etc. Are we seeing the long-awaited, if you like, post-mining boom restructure starting to occur?
Yeah, there's certainly some encouraging signs there of that happening. The number of exporters in Australia doesn't normally change very much from year to year, but what we saw in the numbers in 2013, 2014, the latest readings that we have, there was a dramatic increase in the number of Australian companies involved in exporting. Back then the Aussie dollar was averaging about 92 cents. So we were seeing that response with a much higher currency than we have now. And I think it's pretty safe to assume that part of the story has probably had a further kick along over the last year or so with the drop in the currency that we've seen then. The other thing that's happening here, of course, is we're now seeing, I think, a bit more clearly some of the benefits from the next kind of wave of development in the Asian region in particular. There's a big increase in the number of middle-income consumers in East Asia underway right now. In fact, on the projections, there'll be around about 1.7 billion middle-income consumers by 2020. A lot of people with money to spend, and we're already starting to see that in areas like tourism and education as the other clear winner in this particular story.
If we explore that just in a micro, I suppose, a little bit, say take tourism for example, what are some of the consequences there? I assume we start seeing need for strong infrastructure growth, that sort of thing? Yeah,
look, that's certainly the case. Non-mining construction, as we all know, has been exceptionally weak over the last 4 or 5 years. We need something to get that part of the economy moving, and there will be sort of market-driven drivers there, like the pickup in tourism, and we are seeing more hotels starting to be built in the planning and the like. But you do need more than that. It can't be just a tourism-driven boom. And what we'd really like to see, I think, is more infrastructure spending across the economy. When you're running below trend in terms of economic growth as we are now, certainly higher infrastructure spending is something that boosts aggregate demand, very helpful for driving growth and employment, of course. But we've also got to keep an eye on the longer term here. There are some big challenges the Australian economy is facing, and one of those is getting productivity up. And the one thing we know about infrastructure is it's got a very good payoff in terms of that longer run boost to productivity and incomes across the economy.
Right, but we surprisingly, I think, have seen quite soft infrastructure spend, particularly by government. I think 30% reduction, I think, over the last few years.
Yeah, that's been a particularly disappointing part of the story. The idea was that as mining construction turned down, we'd see a pickup in residential construction. We can tick that one off. We'll see a pickup in non-mining construction. We've seen some of that, not as much as we need, but the real disappointment has been that infrastructure story. 30% drop in public capital spending since the peak of the mining boom back in 2012. Well, rather than helping growth, it's been a big drag on growth through that period, and certainly we'd like to see more. We have the sort of backdrop that we have now, where governments can borrow pretty much as they'd like at 2.5%. It's very difficult to argue that we can't find projects that are going to pay a better than 2.5% return over the next 10 or 20 years.
Right, particularly in an economy where population's still growing and quite a lot of congestion points, etc. Just talking about the currency piece and I suppose the play out in markets. We've seen the BOJ go negative on rates. We're seeing Australian retail rates still relatively strong. Is there a risk that will fuel currency upwards again?
Yes, I think currency markets are one of the major areas of risk that we need to watch this year. And we typically focus on changing interest rates as maybe something that upsets the economy or volatile stock markets, but maybe this time round it's the currency side. I say that because world trade growth has really stalled over the last 4 or 5 years. It's gone nowhere. I think what that's indicating is that long period where we were building up global production chains and the like has come to an end. So countries that relied on plugging into those chains as part of their growth strategy are now struggling a little. What it means is that growth for many countries is now all about what's happening in the domestic economy. Really the question for policy then is, well, how do you contain all that growth? How do you capture it and keep it in the domestic economy and lower currencies, as many countries are pursuing right now, is one of the ways you can do that. Now, we all can't have a lower currency, unfortunately, and as some are going down, then some are going up, and certainly one of the potential upsides is the Australian dollar. When you look at the euro, for example, the European Central Bank, trying to ease policy further, get the euro down. Bank of Japan certainly doing the same thing, it leaves, as I say, the potential upside for the Aussie dollar. So a stronger currency may be one risk that we have to think about over the next year or two.
Right. And I suppose the interplay of the Fed and its monetary positioning will be important there. What's your feeling or instinct on the US? Still similar to what it was in December?
Yes, certainly views on the US growth outlook have been scaled back, and the expectations of what the Fed will do with interest rates in the next year or two have been scaled back as well. But again, when I come back to the fundamentals, it's hard to see one 25-point increase in US interest rates as derailing the US economic story. So we still think the US economy is doing pretty well. We think they'll continue to do pretty well, and the Fed will continue to lift interest rates. They have been at pains, though, to assure everybody that it will be a slow and cautious process. And the other thing to think about here, though, is that with Europe trying to push its interest rates lower, with Japan trying to do the same thing, it also means that longer term interest rates in the US are going to remain pretty low as well. And that's actually more important for the US economic story than what the Fed may be doing with those very short term policy rates. So I think interest rates remain low in the US. They don't derail that economic story.
The softness of income, I think, will be something that, well, I suppose the biggest fear we have is sort of, if you like, a repeat of the Japanese phenomenon. 10 years of pretty tepid growth with a lot of banks, struggling to remain, with international banks, struggling still. Is that a concern for you? Could you see running 10 years of pretty soft sort of growth rates?
Well, I think the problem that we're all facing from the medium-term perspective, and in Japan, in a sense, just further ahead in this process is, well, there's only really two sources of growth. You either have people spending more, or you have more people spending. And of course, as populations age and start to decline, as they are in Japan, then you lose those growth drivers. Fewer people. And of course, as populations age, then they tend to spend less as well. So that DVD player I bought 2 years ago still works. Right. Why do I need a new one? We'll all hit that point at some point. But when you hit that point, what you really want is, like Japan, for income levels to be as high as you can possibly get them. So, it's a far more comfortable adjustment if income's already high than if you hit that point at a much lower level of income. So it leads you right back again to the whole sort of productivity debate in Australia, and the need to really be moving now to set us up for when we eventually reach that point. Right.
And without being too political about it, obviously tax reform has been scaled back from the current phase. Where else do we find that sort of productivity lift then?
Well, the experts have spent a lot of time looking at exactly that question, and as we hear from people like the Governor of the Reserve Bank and the Secretary of the Treasury and so on, there is a list of items there on the productivity agenda that the Productivity Commission has put together. So in a sense, we know what to do. What we need to do is actually get on and start doing it.
Couple of questions just to finish. The Chinese issue, with Chinese markets very volatile, seeing the banks, heavily indebted. You weren't as worried about that. You seem to be having a more sanguine view around China and its ability to keep moving through and shift its economy into a more consumption-driven economy.
Yes, we certainly think that process is underway, and it's harder to see that in the statistics in a sense because most Chinese statistics are very good at measuring production, how many tonnes of steel and like are being produced. They're less good, we think, in picking up what's going on in the services part of the economy and the consumer side of things that's driving that. If you extract more the sort of pure consumer indicators out of China, you certainly get a better looking picture from a growth perspective than focusing just on those production stats like electricity and steel, as I mentioned. So we think that transition is underway, and the income story that's driving that, I think, plays out a positive way for Australia, which of course is our main interest. As incomes rise, people spend more money on food. They want more of it and better quality, and we're certainly seeing that level of interest in the agricultural sector. As incomes rise, people want to live in bigger and better quality dwellings, and the floor area of a new apartment in China is rising, and those bigger apartments need more steel to hold them up, so actually quite good for the coal and iron ore story that's very important right now. Education and tourism receive a boost, but it's also going to be an ageing population in China like everywhere else, and again we know from experience that older populations spend more on health because they have to, and financial services as well. So there's a whole range of sectors there that Australia can benefit from. Unlike the resources story, where we were kind of in the right place at the right time with the right mix, we're going to have to pursue these ones. But certainly the opportunities are there if we're willing to chase them.
Right, and be competitive about it in pricing, etc. Yeah. All right. Well, that's very interesting. Thank you very much, Michael, for your time today.
Thank you.